let's talk to Dr. Corvin Codirla. You pronounce your surname because it's German, isn't it?
Codirla.
Okay. Can you say that?
Corvin.
Okay, so it's just me who can't say it. Corvin, very good morning to you. You're an Arsenal fan, aren't you? You told me off air. Why are you an Arsenal fan if you...
Because of my son.
And that's simple as that?
It's as simple as that.
Are you a man who watches football at all?
Not much, no.
Understood. Now, we met at a London Traders conference a couple of weeks ago and we got talking, and hence you're here today. You're now a trading educator, but you are a former hedge fund manager. What's more difficult, educating people or actually trading the money?
Both. In the end, you deal with people, investors. Investors, if you don't make money, they're going to be unhappy. If you make money, you don't make enough. And on the other hand, with people you educate, it's a very similar give and take situation. So in both cases, it's a people business.
Yeah. So in terms of the hedge fund world, obviously everyone is short-termism, isn't it? In terms of you've got a monthly NAV, okay? You're trying to outperform the markets, huge amounts of pressure. In that situation, how easy is it to make money?
It depends upon the markets, but in the end, you're living with a hard stop on your P&L, and it's the attitude you have towards the money you make. If that money represents the car you're going to buy, the swimming pool you're going to build, and that's constantly in your mind, then forget about it. You're not going to make any money. But if you really just look at your P&L as a stack of chips playing poker, then that's a different situation. You're probably going to make the right decisions. I mean, if you've been in the business for 5 to 10 years, you have an edge, obviously. So it's really the attitude that counts.
Right.
What was the motivation in terms of switching to what I think is one of the most, actually probably more difficult than the hedge fund area, educating people who are new to the market, who tend to be short-term, who tend to not want to follow any rules.
Invariably undercapitalized.
Yeah, and then overgeared.
That's an interesting question. I mean, at the moment, I'm doing both at the same time. But with regards to the material I offer, it's about understanding how you benchmark yourself against the FX markets. So in equities, you've got the S&P, and that's pretty easy. And for commodities, you've got indices, and you've got aggregate bond indices for bonds. But similarly, in the FX markets, you can create indices that show long-term sustained growth around core positions, which you can more or less determine. And they're very much value-driven, like an equity, a currency can be over and undervalued. Or you look at interest rate differentials, because interest rate differentials are the main driving factor for what happens in the currency markets.
Normally, it's not that easy, it's not that clear, and you're sort of going through the fog.
You're absolutely right. So look at 2013 to 14 when volatility got crunched in the markets. I mean, Eurodollar at one point only swung 40 points a day. How are you supposed to make money on that? Certainly, the fact that all the central banks were providing liquidity like crazy didn't make life easier as well, squeezing the risk premium out of the market. The fact is now you have a divergence in central bank behavior, and they're also showing and signaling that they want to remove the liquidity out of the market. And that kind of divergence is going to provide more volatility, more movement, more direction, and even for intraday people, more opportunity to make money.
But the USP that you're offering is really that you're attempting, let's say, to show people who are new to the market or who are maybe already trading but want to learn more how to put or think like a hedge fund manager. Is that right?
That's right.
So that's
a really good, unique selling point, isn't it? Because lots of people get trained.
So. That's why I just thought of that.
Very good point, Zach.
Thank you very much.
So let's just go back, right? The textbooks will say, right, that to be a good trader, you've got to have money in the account, okay? So that you're fully funded. You've got to have a game plan, i.e. a trading system. So you're offering, I'm now going to think like a hedge fund manager. And you've got to have the psychology, okay, to run your winners and let's say cut your losers, okay. How can you teach people the psychology of the market?
That's a very good point. To answer that, let's wind the clock back to the mid-'80s and look at the turtle experiment run by Richard Dennis and his partner William Eckhart. And of course, it was called the turtle experiment because they watched turtles hatch in Singapore and thought about raising traders like you do turtles. How the connection came about, I don't know. But they created a set of rules, which looking back is pretty straightforward. It's a breakout system, nothing more.
55-day highs,
20-day lows and variations on time frame, etc. And then I think the unique point they had at the time, which many people didn't think of, was portfolio construction. So reduce the amount of concentration you have in very correlated markets and try to keep your risk spread out across very uncorrelated markets. And that was a unique construction feature of the portfolio that most people didn't think about. Only really over the last 20 years have people incorporated that into their future strategies. But the most important point is they proved that you can teach rules. As a side effect, and I think Curtis Faith very much in his books has written about this, psychology is a driving point. You might have a system, but if you can't stick to it, then can you change a person's behavior? No, you can't. So, you come to the table, you're going to give it a shot. Bam. I mean, it's like chess. You can learn the rules, but if at the moment, you're suffering from Alzheimer's, you can't remember the openings, you're stuffed. So, you know the openings work, but your memory's gone. What can you do? You can't do much about it.
Okay, so we've got 10 people in the room. They all come to you and go, teach me how to trade.
Yes.
Do you know straight away from looking at them, have good, bad, indifferent? What are the telltale signs?
No, I mean...
Because if it was me, I'd ask them all to play me at chess, okay? And if anyone could beat me at chess, okay, I'd go, you're going to be a great trader.
Look, over the last 15 years, I've met people on a desk who vary in personality across the range, and there's no one unique feature that combines them. I mean, some people will be worth $50 million and come into the office with a sweater with patches and holes, and you'll think, they just must
That's Zach.
under a bridge.
No socks.
No socks.
And others, their life-to-date P&L is probably flat, but they've cashed in their bonus and come to the office with a big flashy car. So it's very difficult to tell from the outside. And in the end, it's the track record that speaks.
So cash is king.
Cash is king.
Nothing else counts. P&L.
Well, that's the great thing about trading. It's probably the only enterprise in the Western capitalist society where the time difference between idea to cash is so short. For most other things, you have to write a book, you have to produce an object, you have to provide a service. Here, it's very much instantaneous, and it's also very black and white. You can't pretend that you're making money when your balances aren't. And so, from that perspective, it's a very clear-cut, very clean situation. It's very easy to understand what happens.
Okay, Corvin, we've run out of time. The fastest 9 minutes we've done for a long time.
Great Thank you very much.